I'm going to do tax, what am I going to do, okay? You're going to have to make that decision eventually. Internal audit is another option. We've got a number of people here in the room who've been involved with this already. Our students, I don't want to steal too much of the thunder. I've got our teaching assistants here. They can tell you more about it. Thanks for being here. This shows your dedication this morning, so we appreciate that. This is the president of our organization, Lynn.
Hey guys, my name is Lynn Mai. I'm just here to talk to you guys a little bit about our student organization. Chris has kind of already introduced a lot of information about internal audit. So really, internal audit is kind of another career path you guys might not have heard about. If you guys are going to be in teaching accounting, expect to see us again do another more class business and stuff like that. But internal audit is not like tax and audit. You can get information about that at our first meeting. It's a lot different. It's much more fun. There's travel involved. If you guys like traveling, there's a lot more talking to people. It's less of accounting work. No backaches. There's not much of here all the time. So we have our first meeting on next Wednesday. We'll be in JSOM 1.517. I wish I had handouts for you guys, but I'll put them out for your guys' class.
What room number will be in?
1.517. It's going to be over executive education on Wednesday at 5:30.
Will there be food?
Yeah, of course there'll be free food, catered food every meeting. Similar to BAP, we have a lot of company receptions throughout the semesters, throughout all of our years. So we have companies like GT, all the big four, EY, PwC of the big four, Southwest Airlines. We had students go to KBRs and the big one, Beaver, FedEx. We've had students go to Microsoft through our program. So we work much more independently from PPA and BAP, but we're not exclusive. So if you're involved with those organizations or you're part of PPA, you guys can also be part of our organization. And give you more information about that if you're a PPA student and want to also do and focus on internal audit.
Hey guys, listen, life is about options, okay? And giving yourself options. Do yourself a favor and please check this out. If you don't like it, you don't want to do it, that's fine. But always give yourself that option. Okay, now is the time. So at least check it out.
Yes, question.
Are there any dues and fees involved?
Yes, there's a couple dues and fees involved. We have a semesterly fee of $20, and that gets you access to all of our resume book as well as all our meetings that we cater food for. So more than pay for itself if you just want food. But there's a lot more to it than that. There's also the national membership, which we asked you to also be a member of. There's a student rate for that. So it could probably run you about, that one will be an annual membership with the international group, and that's probably
I think it's 45.
35 or 45.
35
yeah,
or 45.
It's 35. It's 35 for students for a full year, and then
Yeah.
you have to tack on the $20 per semester with us.
If I can say, it's well worth it because through the program, I've gotten about 5 or 6 internship interviews in one semester alone. You get exposed to talk to people, you get to network a whole bunch. And like Lynn said, the chapter dues more than makeup and free food that you get every week, and it's really delicious food. We don't have pizza every week.
Yeah. So along with that, I mean, how many of you guys are looking for internships or like full-time offers or anything? Everyone should be busy. You have to be confident about it too. This is a very active thing. So like I said, we have a lot of companies coming in to host receptions with us, and they'll also most times conduct interviews the next following day to see if you're a good fit for their internship programs. I know when I switched into accounting the spring semester of my junior year. So take you guys, most of you guys are going right now, and like add another semester. That's when I switched into accounting finally, and I had no previous business experience. I went right into the internal audit class and program, and I was able to start, I got my first internship. I did my first interviews through the class, and that was like really scary, because I didn't know how to, dress professional. I didn't know how to actually fit a suit very well.
Fitting in a suit.
Yeah, Chris's comment that day was, "Whoa, you can really clean up, man," because I was coming in like scrubs most day. But I got my first internship experience with FedEx office. I was like a 6-month stint, and then I got into PwC the year after, and never did like in a million years really see myself being into Big Four. But the opportunity came up through the program, and I just wanted to take advantage of it. So why not? And I just want to tell you guys, like, there's a lot of opportunities there. So if you guys haven't had internship experience yet, there's a lot of professional development that you can get from our program. So perfect. That's about it. So I hope to see you guys next week. 5:30. You have a question?
What time is it on Wednesday?
5:30 p.m.
Yeah, please
And they'll
proceed.
give the information and I'll start flooding you.
There
but
you
I
go.
figured I'd wait till a while.
So we'd love to see you guys out there.
And come see me anytime you have questions, okay? Come up on the floor with these guys. All right, good luck.
Thank you, Chris. Right here, there's an open seat, right here. I don't want you in the back. You're gonna be one of my main accountants, I remember you. Yes? That's coming. I was just gonna get good way to start me off. Okay, the packets, they're coming. I actually sent Nancy Boughton, one of our assistants, back up to make another 25, 30 of them. Okay, when Nancy comes back, I'll make sure everyone in the room has the packets. Okay, also Professor Troutman has been nice enough. We are also going to email these packets to you. Okay, I'm going to send it to everyone. I'm going to be fair. I send everything to everyone. I'm very, very transparent. Those of you who know me, just come ask me and we'll give it to you. What's being filmed, okay, you have to talk loud too, because there's a lot more people in the room so they can hear you. Oh, that's what the filmer told me to tell you.
Filmer, is that an official term?
Yeah, filmer. I'm not shooting it's a good promotion. You're a filmer, all right? We'll send a link to you so you can see everything again. So you can, if you want to click on it, you want to download it to your iPod, iPhone, whatever, it's there for you. Okay. So about 12:30. It depends how close Professor Troutman's going to go. We, the accounting department or accounting area, will have food for you outside. Okay, I'm kind of leaning towards pizza because I don't want to take an individual menu because I know Michael doesn't like onions and I know Johnny doesn't like tomatoes and I'll mess everything up. All right, so I'll probably lean towards pizza. All right, anyone have a preference on pizza? Okay, I'll have a variety out there for you, from pepperoni to garlic to whatever, just plain cheese, and I'll make sure there's a vegetarian thing. Okay, come on in, come on. I'm looking for a seat. Okay. Oh, there's one next to Michael. No one likes to sit talk to Michael. You know? He's got to go some elbow room. All right. So, having said this, okay, I'm going to turn it over to Professor Troutman, and I think we're going to probably go for 2.5 hours. Okay.
We're gonna rock and roll.
Okay. All right. Good luck, and then let me know, and then I'll give you what you need.
Yeah.
Okay.
Hi
all right.
guys, how is everybody?
Good.
Yay, we're excited.
Yeah.
Did you ever think you wanted to show up to class and, compact all of accounting 2301 in 2 or 2.5 hours? That's our goal today. I'm Amy Troutman. I will keep the introduction very brief because I want to get rocking and rolling, like I said. My name is Amy Troutman. I teach the 2301 course, the Intro Financial Accounting course, and I see lots of familiar faces. The purpose of today's class is to do a very quick 30,000-foot overview of 2301 to make sure you've got your confidence back and make sure you feel that you have mastered the introductory level knowledge of financial accounting. Because next week, or perhaps next spring, all of you are going to be stepping into Intermediate 1, the course that builds onto this course. So we're going to walk through this packet that is coming slowly. We're making more copies as we speak. We're going to go through this packet throughout the next couple of hours. My goal is to go very quickly, okay? So I fully anticipate that a lot of you, unlike in class where you're taking copious notes, I think a lot of you are probably going to be sitting back and just listening and taking it all in and making mental checks and going, yeah, I know this, I know this, I know this, I know this. Every once in a while you can make a little note if you need to. But I fully expect that. So I'm going to go ahead and get started with the notion that a lot of you don't have your packet. I've got all the slides, but I think most of you will probably just feel that this is a good review. The first kind of subset of this review is going to be me lecturing and going, okay, everybody, remember the 4 financial statements. Here they are. Let's talk about them one by one. Let's make sure we know them. Let's make sure we know how they flow together, so on and so forth. The second half of this review is going to be a little bit more problems. We're going to work through problems. We're going to work through them pretty quickly, so hopefully we'll have packets by then. How do we want to do this? Questions as we go along. If you've got questions and you are just totally lost, if I'm going too slow, going too fast, I'm open to it. Y'all just raise your hand, yell out, don't be shy. This is, you're not getting graded on this. This is totally a review for you. So this is the service we're doing. This is the first time we're doing it. We want you to make sure that next week you go into Intermediate 1 with a whole load of confidence that you have mastered the introductory level knowledge of financial accounting. Are we good? Okay, let's go. We start off our talk in financial accounting about financial statements. There are 4 financial statements that you need to concern yourself with, and they are up here, 1, 2, 3, 4. The income statement, the retained earnings statement, the balance sheet, and the statement of cash flows. walk through. I've got a couple of slides on each one of these financial statements. I'm gonna walk through and make sure you remember them. But anybody who prepares financial statements, any company, will have these 4 pages within their annual report, within their 10Ks, within their 10Qs, within any financial statement data that they prepare, okay? So, let's first walk through. Let's first turn this on because it worked about 5 minutes ago. Okay. Okay. Income statement. If you remember what an income statement is, here's a sample over here on the left. An income statement shows the net income or net loss for a company for that year or for that period. So one thing that you need to see is, damn it, this just worked a couple of minutes ago. I promise. It shows for the month ended October 31st, or for the year ended. It's an entire year, an entire month's worth of revenues and expenses to get down to a positive number down here for net income or a negative number down here for net loss. Okay, so if you remember anything about the income statement, you need to remember that it's for the entire period, whether it's a month, a quarter, a year, what have you, and that the basic formula for the income statement is revenues, all the money that the company earns from whatever it is that they do, minus expenses, all of the expenses that they have to pay, salaries, they have to pay their employees, that's an expense. Rent expense, if they are renting a factory building or renting some retail space. They've got supplies that they use, that's another expense. Expenses are just costs of business, okay? So you've got all of your revenues, all the money that you make, minus all of your expenses, all of your cost of running your business to get down to your net income or your net loss, okay? And it's for that period of time. A lot of people use past net income to provide information to provide predictive information for future net income. Okay, and then we've got our little arrow from our income statement, our net income, to our second financial statement, which is our retained earnings statement. And a retained earnings statement basically tells you, if you remember, tells the reader the earnings of the company for whatever period that the company decides to keep, okay? Whenever a company makes net income, whenever they earn net income, they've got 2 choices. They can either keep it or they can hand it out, right? You can either keep it or you can hand it out. The retained earnings is just the earnings, the income, the cumulative income that a company has decided to keep for themselves and not dish out in the form of dividends, okay? So our retained earnings statement is basically walking you through what you had as retained earnings at the very beginning of the period. So your beginning retained earnings, you add in any net income that you earned that year. Okay? So your beginning retained earnings plus your net income, subtract off your dividends, okay? And this company had $500 that they handed out in the form of dividends to all of their owners to get to an end retained earnings number. So again, the retained earnings statement walks forward the earnings that a company decides to keep themselves for that period of time. It's for a year, it's for the same period of time as your income statement, so they both up there say for the month ended October 31st. Okay. And the net income, like I said, is needed to determine the retained earnings. So we've talked about the statement. It shows the amounts and the causes of the changes in retained earnings during the period. The time period is the same as that covered by the income statement. Okay. And users can evaluate dividend payment practices. So one of the things that the retained earnings shows you, obviously, is if they hand out dividends. Okay, and whether or not you want to invest in a company may depend on whether or not you're going to be earning dividends. So you can go back and look at a retained earnings statement and say, you know what, they do hand out dividends, and I would really like that to be a component of any company that I decide to invest my money in and decide to buy shares of stock in. Okay, so you could use that to determine their dividend payment practices. Okay, so we have talked about the income statement, we've talked about the retained earnings statement. The third financial statement that companies build is the balance sheet. Okay, and the balance sheet, I use my little gimmick in class. The balance sheet is different than the 2 financial statements that we previously talked to, because I'm borrowing your phone. I'm going to use your picture because, do you have your volume on? Probably not, but I'm going to take a picture of my balance sheet. Okay, a balance sheet, I'm using my picture on my phone, and I'm taking my picture. A balance sheet shows you the balances of the accounts at a moment in time. You click, you take a picture. and that shows you the balances of all of these accounts at that particular time, which happens to be October 31st. So you see that the title is different than the income statement and the retained earnings statement. Just says October 31st, 2014. So they close their books, they close their door, it's midnight on October the 31st, and they add up all of their balances of all of these accounts. Okay, and that's what the balance sheet shows you. It shows the balances of 3 different categories of accounts: assets, liabilities, and stockholders' equity. Yes? So our balance sheet shows all of our assets and what we have in those asset accounts at the time. So cash was $15,200, for example, on October the 31st. When you added up all the cash accounts, okay, and subtracted off anything that was that had already been removed from their accounts. And then you also add in, assets, you have a grand total for your assets, and that should always equal the total of your liabilities and your stockholders' equity. Okay? Liabilities are those outstanding IOUs that you owe to your vendors, perhaps. So those accounts payable, for example, if you are running a tennis shoe company, I've used that in class before, and you buy all of your shoelaces from an outside vendor who happens to make those shoelaces. You buy all of those and they ship them to you. They send you a bill that says, "Hey, pay us for the shoelaces that we sold to you." Well, you have an outstanding IOU with that shoelace company, and that's in the form of an account payable. So if you haven't paid that bill by October 31st, it's still an outstanding IOU sitting in your liabilities. Okay, so you have a subtotal of all your liabilities. You add that amount to all of your equity, your stockholders' equity, and the information that's included in stockholders' equity, if you recall, is anything related to the ownership of the company, so common stock, and any additional paid-in capital accounts, the amounts that are paid over common stock, and then good old retained earnings. Okay? We know retained earnings because we just made a whole financial statement on it, right? And that's how these two tie together. Okay, so we've got our end retained earnings balance as of October the 31st, and you will see that that's the number that shows up in your balance sheet in your stockholders' equity section. Okay, so we've got 3 financial statements. We've got our income statement. It's for the period, for the month ended October 31st. Revenues minus expenses equals net income or net loss. That flows into your retained earnings statement that is also for the period ended October the 31st. The formula, the basic formula of the retained earnings statement, beginning retained earnings plus net income minus your dividends equals your end retained earnings, and then you've got your balance sheet. That is for the period, just for October the 31st. Take a picture, the moment in time. It shows the balances of all your assets, all your liabilities, all of your stockholders' equity accounts. Too fast or too slow? Am I doing okay? Yes, okay, keep going. Damn it, I don't know what happened to the thing. Okay, so the balance sheet, I've already kind of talked about all this, but you've got a slide in there, and again, slides will be coming for those of you that don't have them yet. The balance sheet reports assets and claims to those assets at a specific point in time, as of October the 31st. The formula, as I've mentioned, assets equals liabilities plus stockholders' equity. And then you always list the assets first, followed by liabilities, stockholders' equity. In your classified balance sheet, we break it up a little bit more. You will do that more in intermediate, but this is just the basics, where you're just listing your assets in order of liquidity, if you recall that from 2301. And then you list your liabilities. You put current liabilities on top, long-term liabilities after that, and then all of your equity accounts. Equity is always your ownership piece, so the common stock, okay, and if there's any additional paid-in capital related to that, and then, your retained earnings, okay? The fourth piece of paper, it's in everybody's financial statements, is the statement of cash flows, okay? So we have talked about the income statement, retained earnings statement, the balance sheet, and now let's do cash flows. I say this in class, so if you've heard this before, if you've had me before, we spend an entire financial statement on cash, okay? So we spend one entire piece of paper just showing you the details behind that $15,200 amount, okay? We spend an entire piece of paper on the statement of cash flows because just like cash is important to you and I, it's gonna buy us a whole lot of pizza this afternoon, it's important to companies as well, okay? Everybody needs cash to run their lives, to run their business. So we wanna know, outside users of accounting information wanna know what companies are doing with their cash, okay? This provides a lot of information about how the company uses its sources of cash. So it is broken into 3 different parts, and we're going to go through a little bit more cash flow at the very end of this class. But it is broken into 3 different parts: the operating, investing, and financing sections of the cash flow. Okay, and the reason it's broken into 3 different parts is for you and I as outside readers to be able to easier understand what they're doing with cash. Cash flows from operations, okay, the very first section tells us as a reader how they are using their green dollar bills in operating their business. So it'll say cash receipts from operating activities. That doesn't give us any details. Cash outflow from rent expense, cash outflow from utility expense. If they wrote a check and paid $100 to pay their light bill, it will be in the cash flow statement that says cash outflow from utilities expense or from paying utilities or whatever, $100, with a little bracket around it because it'll be a negative, an outflow. Okay? If they made money from selling tennis shoes, it'll say cash receipts from sales of tennis shoes, and it will be a positive number. Okay? So that all the cash flow statement does is tell you the inflows and outflows of cash, okay, the actual green dollar bills. And so what you've got is you've got 3 different sections. You've got the operating activity section, which shows the cash flows from operations, running your business. You've got the investing section, the second section, which shows the inflows and outflows from any investing activities that the company partakes. So if they buy big assets, if they go and buy a big delivery truck to move those tennis shoes, that delivery truck, that purchase of that delivery truck, that equipment, they are investing in their business to make it better. So that is a cash flow from investing activities. So those types of activities are included in the second section, the investing section. And then the cash flows from financing activities are what are any cash inflows and outflows related to getting their business funded, if you will. So anything related to equity, like if they issue additional shares of common stock and they get cash for it, okay, cash inflows from financing activities goes up. So the issuance of common stock right there is an inflow, a $10,000 inflow related to financing activities. If they go walk down to the bank and get a loan for $5,000, you can see that they've got a positive number related to financing activities. They walk down to the bank, get a $5,000 loan, issuance of note payable. So that cash flows from financing activities goes up, okay? So you've got these 3 categories that shows all activities, all movement of green dollar bills. And you get a subtotal, your net change in cash, that $14,500. You add that to your beginning cash balance, and this looks like it was a new business, so they had 0 cash at the beginning. The other place you can find the beginning cash balance is the same thing as last period's end cash balance, right? We all remember that? And you can walk forward to get your end cash balance, and that should always tie to your balance sheet, okay? So we've got 4 financial statements, the cash flow statement being the last one. And the cash flow statement can answer all these cool, wonderful questions. Where did cash come from during the period? How was cash used during the period? What was the change in cash balance during the period? So on and so forth, okay? So we've got those 4 pieces of paper. We also, in an annual report, bring one, yeah. This is Coca-Cola's 10K. Y'all may have seen this if you have been in any of my classes before. Coca-Cola, their 10K right here is the super formal document that they have to file with the SEC every year in order to maintain their public status. All public companies have to provide certain reporting documents to the SEC in order to stay good, in order to stay good with the SEC and be able to continue to be traded for their stocks to be traded on public markets. The Coca-Cola 10K is this one right here. It was for the period ended, I don't know, December 31st, probably 2012 or something. Who knows? Right here, December 31st, 2012. So inside this 10K are those 4 pieces of paper. Okay, but there's other information in here. You can see that it's more than just 4 pieces of paper. It also has these things. Besides the financial statements, it always has an MD&A section, management discussion and analysis, that gives the company the ability to tell the world about what they've been doing. We bought a new bottling plant, we sold some stuff, we rolled out the new Share a Coke line, and it's been wildly successful, and yada, yada, yada. They spend the first 30 pages in the MD&A section. Management gets free rein to talk to the users of this information about what's been going on with the company. okay? And then they've got the financial statements, those 4 pieces of paper. And then they've got some notes behind the financial statements. And the notes behind the financial statements give more information about what's on those 4 pieces of paper. So there's a little old footnote about cash that says, this is how we account for cash. This is what we include in our cash accounts. In the inventory footnote, it'll say, we have this much in inventory. As you can see from our balance sheet, we use LIFO, FIFO, average cost, we use whatever, and this is the effect of it. And it goes into more detail behind those 4 pieces of paper. So you've got the management discussion and analysis at the beginning of any 10K that says all the great and wonderful things that Coke's been doing. Then you've got the 4 financial statements, and then you've got the notes to the financial statements that provides additional details so that you and I can go look, find more information about dividends or inventory or cash or whatever. And then there's also an auditor's report. Okay, and John joked about it earlier, Professor Garden joked about it earlier. You have to get audited. If you're a publicly traded company, you have to be audited. So Ernst & Young comes in and audits Coca-Cola, and they check and make sure all this stuff is right, because you and I, as external users of this information, want to make sure it's right. So we go to that audit opinion and see that Ernst & Young has checked it over, and that's called an auditor report or an audit opinion, because there's a paragraph in there that says, in our opinion, we believe the financial statements of Coca-Cola are free of material misstatements, blah, 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 blah. Okay? So that's what's included in financial reports. Good? Woo. Okay, so let's do a quick wake up and make sure we are good. Who doesn't have a packet yet? I'll give you the answers. I'll give you the answers later on. Okay, you'll get it in an email. You'll get the packet in an email. Y'all yell out. I want to know if match each of the following items to its proper balance sheet classification. These are some accounts that we see on those 4 financial statements shown below. If the item would not appear on the balance sheet, tell me NA. So what about salaries and wages payable? What is that? Current liability. Darn it. Current liability. Yes. What about service revenue? In it. Service revenue is that first line item on the income statement. Okay, it is not on the balance sheet, it's on the income statement. Revenues minus expenses equals net income. It's got this funky word service in front of it. You need to get used to the fact that it may say service revenue, it may just say sales revenue, it may just say revenue. Some companies sell stuff, sell merchandise, sell tennis shoes. Some companies sell, not themselves, sell services, sell, back row, sell whatever, sell a service, okay? So that would be a service revenue. They're not actually selling items, goods. They are a service company. What about interest payable? It would be a current liability, okay? Interest payable, any interest that you have associated with some sort of loan. Goodwill, do y'all remember what goodwill is? It's an intangible asset, which is a long-term asset. Okay, goodwill is a long-term asset that sits in the long-term asset section of a company's financial statements. Oh, sorry, I forgot to ask. Depreciation expense. Okay, you see the word expense? It shows up in the income statement, revenues minus expenses. It's one of those expenses that comes out of using your long-term assets. Mortgage payable that's due in 3 years. Long-term liability rather, so it goes in the long-term liability section, the bottom half of your balance sheet. Yes, good. Investment in real estate. It's a long-term investment that goes in the asset section. Okay, so it's a long-term asset, an investment in real estate. Anybody own a house in here? Yeah, if you've invested in some sort of real estate, you own a house, so you've got an asset on your books. It says house. You've also probably got a liability that says mortgage payable. Yeah, so you've got a long-term asset, you've got a long-term liability. Okay, equipment. What is it? PP&E. Yeah, PP&E is a long-term asset. Property, plant, and equipment is one of those categories in your asset section that is a long-term asset. Property, like land or buildings, plant, equipment, those kinds of things. Accumulated depreciation. Y'all remember what that is? It goes in PP&E. It's a contra asset account. And again, we'll go through. We're going to kind of break a lot of this stuff down in a minute. So we'll talk about depreciation and long-term assets more in just a few minutes. Accumulated depreciation, to give you the 30,000 foot review of accumulated depreciation. When you've got a long-term asset, if you own a car or a truck, delivery truck, okay, that is a long-term asset that sits on your balance sheet, correct? Okay, that truck you may have bought for $50,000. As you use it, it is not continually worth $50,000, correct? Over time, you use it, it wears out, it becomes worth less. So you have to depreciate it. The way you depreciate it, in an accounting records point of view, is you've got an entry to record the depreciation expense, the cost of doing business related to that asset. So you record a depreciation expense, it shows up on your income statement, and then you also record a reduction in the overall value of that delivery truck. And that, you don't reduce the line item called equipment or the line item called delivery truck. You reduce the value of the overall asset by recording an accumulated depreciation. Accumulated depreciation is a contra asset that goes to reduce the value of that delivery truck. So the net book value, the net value of that delivery truck is $50,000 minus anything that it has been depreciated up to that point, right? Okay. Okay, debt investments, these short-term investments are assets. I still got a lot, I can't believe, thank you for making all those copies, Nancy.
Who doesn't have one?
That back corner. Yeah. Thank you, Nancy. Okay, let's do these last two real quick. Last, retained earnings we talked about is stockholders' equity. That's half of stockholders' equity. There's the ownership piece in common stock, and then we've got the equity piece, the retained earnings piece, okay? And then the last little item, unearned service revenue. Unearned service revenue, if you remember, is a current liability. Everybody good with all these? Okay, I'm gonna keep going. I'm just gonna keep on chugging. If anybody has questions or needs anything, again, yell out. So we've done a quick overview of the four main financial statements, okay, and what's included in the other stuff that's included in an annual report. Now let's break down and talk about the, we're gonna start putting things into transactions. So we've got, anytime a company runs its business and operates, it sells things, it buys equipment, it buys shoelaces to put into merchandise to sell. Every time it has any sort of business transaction, we need to record those in our accounting records so that we can then produce financial statements, okay? So a lot of times we use our accounting equation, our basic accounting equation, to analyze and to record these business transactions, okay? The top row should look very familiar. Assets equals liabilities plus stockholders' equity. Break that down into a little bit more. We've got our common stock piece, the two parts of stockholders' equity. We've got our stock piece, and then we've got our retained earnings. And if you recall with retained earnings, that includes our net income, revenues minus expenses, and our dividends, minus our dividends. Oh, thank you very much. Everybody got one? Anyway. Thank you. Thank you. There you are. Okay. So we've got all of these components. This is basically our income statement right here. All of this is our retained earnings statement. We've got our balance sheet, okay? And then our cash is included in our assets for our cash flow statement, okay? If you remember this slide from 2301, we now need to talk about these lovely words that we all know and love, debits and credits, okay? And we are talking about recording these business transactions, taking what we do in everyday business and recording them so that they are usable in our financial statements. We need to use the process of debiting and crediting our accounts, okay? This double entry accounting system is what basically the whole world uses, okay? So we've got these words, debit and credit. We're gonna quickly review them and then we're just gonna use them for the rest of the time. But as a quick review, I've always found over the years that it is better to ignore what your brain tells you about the words debit and credit, okay? Throw out what you think about when you think about your debit card. Throw out what you think about when you think about your credit card. Just think of these as two words, okay? Debit means left, credit means right. Debit means left, credit means right. That's all it means. We debit anything that shows up on the left side of our T accounts. We credit anything that shows up on the right side of our T accounts. So we've got T accounts that we create for each individual account that we have. Cash has a T account that shows all of the debits and credits related to cash. Okay, accounts receivable has debits and credits, has a T account that shows all the debits and credits related to accounts receivable. Okay, so debit always just means left, credit always just means right. Easy enough. When we debit, when we debit and credit things, it's a matter of increasing or decreasing different accounts. And whether you are an asset or a liability or equity component, it depends on whether debits mean increases or credits mean increases, and vice versa. Okay, so a quick review of them. This is a great quick review of them. Anytime you've got assets, when you are recording an increase in an asset, someone walks in and hands you $500, okay, you increase cash, you are debiting cash, okay? If you are paying your light bill, okay, so you're writing a check and your cash is going down, your assets are going down, you are crediting assets, okay? So any addition, increases to cash or assets or debits, any decreases or credits, okay? Liabilities are just the opposite. Anytime you increase a liability, you walk down to the bank and get a bank loan, you get $500 cash, so your cash increases with a debit, but you now have an increase in a liability, a note payable, a loan, an outstanding liability, so your credits are increasing. Okay, so a bank loan, walking down to the bank and getting a loan, is an increase to a debit, cash, or excuse me, an increasing to a liability with a credit. Okay? So when you increase liabilities, you credit them. When you decrease them, you debit them. Common stock works the same way as liabilities. Okay? Anything on this side of the equation that increases this side of the equation works in the same manner. Okay, so common stock is increased through credits, decreased through debits. Same with retained earnings. It's increased through credits, decreased through debits. Okay? Same with revenue. Okay, because revenue causes an increase to our overall retained earnings. It's increased through credits, decreased through debits. Dividends and expenses, because they are reductions to your stockholders' equity, they actually are treated in the same manner as your assets. Okay? So they are increased through debits and decreased through credits. Everybody good with this? Everybody remember this? Assets, dividends, expenses, ADE, okay, are increased through debits. The other thing we need to just briefly mention as we are talking about recording transactions, taking these business transactions and recording them into financial statements, is these very quick principles I'm going through fast, okay? We've got the periodicity assumption. Periodicity assumption just tells us that we've got this business that runs, okay? Every day the business opens its door, tries to sell things, tries to make money, tries to come up with new things. It doesn't matter if today's Monday, it doesn't matter if today is October 1st, it doesn't matter if today's December 31st. It always opens its door and always runs its business, okay? What we do in the accounting world is we chop the business life into finite units so that we can say, okay, in October we made this much money. So the periodicity assumption just takes the economic life of a business and divides it into these artificial time periods, months, quarters, years, what have you, okay? The revenue recognition principle is that idea that we can record a revenue when it is earned, basically, okay? So we do not have to wait on cash to show up. We use this accrual basis of accounting, if you recall, okay? We use this accrual basis of accounting and record revenues when we earn it. We may bill our clients and they may pay us later. The idea of the revenue recognition principle says you can record revenue when it's earned. You don't have to wait for cash. Cash will show up later. Okay, so revenue is recognized in the accounting period in which the performance obligation is satisfied, when we have performed our obligation. We've done our back rub service, or we've sold our tennis shoes, or whatever. Okay, the expense recognition principle goes along with the revenue recognition principle and says, hey, anytime you've got expenses, you record them in the same period in which the related revenue was recorded. Okay, so you match the expenses with the revenue in the period in which the company makes the efforts to generate those revenues. It's also called the matching principle. And then the last one, revenue expense recognition, is in accordance with GAAP, okay? Just remember the fact that we follow GAAP, generally accepted accounting principles. All of these rules that we follow, that are mandated are GAAP, generally accepted accounting principles. We're good? Okay. When we are talking journal entries, I showed you debits and credits with the T accounts that we learned in our intro classes. Okay, our T accounts that show our lefts and rights for debits and credits. When we do journal entries, all we're doing is we're taking all those T accounts and putting them in a tabular format. The recording of financial data that pertains to business transactions in a journal such that the debits equal the credits. And just as a little reminder, we'll go through this several times, when we record debits and credits, our journal entry format, we debit whatever account it is right here, and we put the amount, and then we credit whatever account it is, and by indenting it, putting it on the next line, and record whatever amount right here. Okay, that's our journal entry format. We've taken our debits and credits, our increases and decreases, and just putting it in a journal entry. Okay, adjusting journal entries are those adjustments that we have to make at the end of those periods because we have this periodicity assumption that we follow, and they ensure that the revenue recognition and expense recognition principles are followed. We've got deferrals and accruals. Okay, so let's go through a few examples, a few adjusting entries just to make sure our mind is working properly, make sure we've got the final kind of basics of creating these financial statements and taking transactions and putting them into journal entries. So we've got a corporation that purchased supplies that cost $2,500 on October the 5th. So on October the 5th, they debited supplies for $2,500. They recorded the purchase by increasing or debiting the supplies account. Okay. This account shows a balance of $2,500 at October 31st in the trial balance. And then an inventory count at the close of business on October 31st reveals that $1,000 of supplies are still on hand. So on October 31st at midnight, they opened up their supply cabinet, counted everything up, and said, we don't have $2,500 anymore worth of supplies, we only have $1,000. So we need to make an adjusting entry to record the fact that we've used $1,500 worth of supplies during the period. The way we do that, we need to reduce our supplies account and show that we have used $1,500 worth of supplies. So when we reduce an asset, we are crediting an asset, okay? We are crediting an asset by $1,500, and we're recording a supplies expense. An expense is just a cost of doing business. We ran our business for a month, we used $1,500 worth of supplies. So the adjusting entry to record that would be to debit supplies expense into credit supplies. Good? Okay. Another example, insurance. Let's talk about insurance. Another adjusting entry. On October the 4th, right here, we have an asset called prepaid insurance. They paid $600 for a 1-year fire insurance policy. Okay? They are now insured for 1 year because they bought this fire insurance policy on October the 4th. Okay? Coverage began on October the 1st. Sierra recorded the payment by increasing or debiting the prepaid insurance, which is an asset. Okay? We have the asset, the ability to be covered by insurance for the next year. The account shows a balance of $600 on October the 31st. And so what we need to do is we need to make an adjustment at the end of October to record the fact that we have used 1 month worth of the insurance policy. The way we do that is we take our $600 insurance policy, we chop it into 12 bits because we need to record 1/12 of it. So on October the 31st, we make an adjusting entry to record the fact that we have used part of that insurance. Okay? We reduce our asset called prepaid insurance by crediting that account. So now we only have $550 worth of insurance outstanding. Basically, that asset is reduced to $550, and we record an expense of $500. We debit our expense, and we credit our prepaid insurance. You'll remember, we increase expenses by debiting them, right? Okay. Another example, I think this is the last one, unearned revenues. Unearned revenues, if you remember what unearned revenues are, somebody walks in, hands you money ahead of time for services that you will provide, that the company will provide at a later point in time. So things like season tickets to Mavs. You pay for all of your season tickets on day 1, and then you get to go to the games, the 40 home games over the period of whatever the season, okay? So season tickets, magazine subscriptions, you send off to Sports Illustrated, pay your $20, you get an issue every couple of weeks for that. You prepay for it. It's an unearned revenue. For Sports Illustrated, okay, for the magazine company or the sports team, it's an unearned service revenue, because they've received cash for a service that they have yet to provide. So they have an outstanding liability to you. So that unearned service revenue is not a revenue, even though it's got revenue in the word. It's going to be a revenue at some point, but right now it's a liability because they owe their customers something, a magazine, a seat in the arena, or whatever. So Sierra Corporation received $1,200 on October 2nd from RNOX for guide services for multi-day trips, expected to be completed by December 31st. So we've got October 31st, excuse me, we've got a liability on October 2nd that was recorded at $1,200 when they walked in and handed them cash. Unearned service revenue shows a balance of $1,200 on October 31st trial balance before we make any adjustments. From an evaluation of the service Sierra performed for Knox during October, the company determines that it has earned $400. Okay, so they need to true up their financial statements and record this adjusting entry to record the fact that they have provided $400 worth of service. So they reduce the liability by debiting that unearned service revenue. They reduce the liability by debiting unearned service revenue for the service that they provided, and then they record a credit to service revenue, to actual revenue that shows up on their income statement for $400. We all good with this? We record revenues, increase revenues through credits. Okay, reduce liabilities through debits. In October, Sierra performed guide services for $200 that were not billed to clients before October the 31st. Okay, so let's walk through these. Okay, so in October, we've got a service revenue that they performed services that were not billed to clients. So they've got some other revenue that they earned that they have not billed any other clients for. So this wasn't an unearned service revenue situation, it's just a revenue. They took somebody on a tour and billed them and said, now you owe us $200. So they provided the service, they have done what they needed to do to record the revenue. So they record a revenue by by crediting the service revenue, and now they've got an outstanding IOU from their customer for $200. They record an account receivable. Okay? Increased asset called accounts receivable by debiting accounts receivable, crediting service revenue. Everybody good? Whoops. Okay, I think this is maybe a little less simple. Let's talk about interest. Some more debits and credits. Let's make sure we know what we're doing. Sierra Corporation signed a 3-month note payable in the amount of $5,000 on October the 1st. Okay, so they have an outstanding IOU, $5,000. They walked down to the bank and got a loan on October the 1st, $5,000. Okay, the note requires Sierra to pay interest at an annual rate of 12%. So they walked down to the bank on October 1st, said, give me money. They said, sure. They got $5,000. They have $5,000 cash. They also have a $5,000 outstanding note payable in their long-term liability. If it's a 3-month note, short-term liability. Okay, they need to record interest on this. So after 1 month, they need to record the fact that they have used that loan for 1 month. Okay, and when you calculate the interest, if you remember just a simple interest calculation, you take the principal, the face of the note, times the interest rate of 12%, times 0.12, times the terms, which is 1/12, 1 month. Okay, and so it's $50 of interest that they have incurred for the last month of using that $5,000. And when they record that, they have to record an interest expense related to that. So they have used the note for 1 month. They've used that $5,000 for 1 month. They record an interest expense by debiting interest expense for $50. They haven't paid it back yet. They're going to walk back on the last day and pay it all back. So they have an interest payable now for $50. So they have an outstanding note payable for $5,000, an outstanding interest payable for $50. Yep. Okay, let's talk about payroll or interest for paying our employees with this periodicity assumption. They were last paid salaries on October the 26th. Okay, they were paid on the 26th. People were paid up on the 26th. And the next payment of salaries will not occur until November the 9th. So they're paid every other Friday, it looks like. Okay. The employees received total salaries of $2,000 for a 5-day work week, or $400 per day. Okay, so employees are earning money day after day, $400 every day that they work. Okay. What we do is we're taking their payment, their payday schedule, their salary schedule, and we're cutting it off in the middle. But we're making our financial statements right here, so we need to record the fact that people have worked for 3 days, we haven't yet paid them. They have earned it, so we have incurred an expense, but they have yet to be paid for it. So we need to record the fact that we've got a salaries and wages expense for those 3 days on the calendar that our employees have worked, but we haven't paid them. And we now have an outstanding payable. So we're not gonna pay until November the 9th. We're gonna reverse this when we pay it on the 9th, and we credit cash. But right now, we need to record that expense to true up the financial statements as of October the 31st. Okay? How we doing? Are we doing okay? Are our brains okay? Can we keep going? Okay, get to your package. We're gonna do one kind of long problem that summarizes everything that we talked about in the last 30, 45 minutes. Okay? Y'all haven't done yet? I told you this is hardcore. Or fast. Okay, Death Valley. Okay, Death Valley. Death Valley has the following accounts, or the following account balances in their trial balance as of August the 31st, 2014. Okay, so at the end of August, they have a cash balance of $24,600. They have a supplies balance of $4,300, so on and so forth. We've got all of our account balances as of August 31st, 2014. We've got some other information, so we're going to make some adjusting entries just to make sure we know what we're doing, getting our practice with journal entries, with making journal entries, with adjusting journal entries. And then we will, I think we're going to go all the way through it and make financial statements, okay? So, the very first thing that they tell us is that some other things have happened. So we've got an insurance that expires at a rate of $500 per month. So we've got prepaid insurance right here, $5,400, okay? At $5,400. We have used another month's worth of insurance. So we need to record an adjusting entry to record the fact that we went through August and we need to show that we used insurance. Okay, so if you remember, you recorded debit first for our insurance expense for $500. And we are going to credit our prepaid insurance by $500 because we are reducing the value of that asset. We are using it little by little over time. Every month, we use $500 worth of it. We're reducing it. And the expense comes into play. We always debit expenses when we increase expenses. Expenses come into play because it's a cost of doing business. We were insured for the month of August, so we need to record it. Okay? Does it say for 3-month period? Per month. Insurance expires at a rate of... I've already messed it. Oh, shit. Shoot, sorry. Excuse me. Our instructions. Okay, sorry. Thank you. Journalize the adjusting entries on August 31st for the 3-month period. Thank you. Sorry, I've already messed up. Don't have loads of faith in me. I can tell. So we do 3 months. So we have $500 a month. So we've got 3 months, so $1,500. Thank you. Thank you. Let's work through journalize the adjusting entries on August 31st for the 3-month period. So we're going to work through all of the other data and see if we need to record adjusting entries for this as well. Okay? Any other entries? We've got a count of supplies on August 31st that shows $900 on hand. Okay? So if we look at our supplies for the last 3 months, we had $4,300. We now only have $900 of supplies on hand, so we need to record the fact that we've used the difference between those two. $4,300 minus 9. So I'm going to record a supplies expense for $4,300 minus 900 to get us down to 900. So that would be $3,400. And we reduce the value of our asset called supplies by $3,400 as well. Okay? Going. The third piece of other data, our annual depreciation is $6,600 on buildings and $4,000 on equipment. Okay? And we're recording this for a 3-month period, like it was we were told in Part A. So we need to make an adjusting entry for our equipment, our buildings and our equipment for that 3-month period. Okay? So to record depreciation, if you recall, you debit depreciation expense. Okay? And you credit accumulated depreciation. Okay? Now for our buildings, it's $6,600 is our annual depreciation. We're only doing it for 3 months, so we need to divide this number by 4, or divide it by 12, multiply it by 3. Okay, so if we divide it, our 6,600 divided by 4, I've got the answers right here. We get 1,650. So we're debiting depreciation expense by 1,650 and 1,650, and that's for just our buildings. Okay, we can do the exact same thing again for our equipment. We have depreciation expense will be our debit. Our credit will be accumulated depreciation, which is again that contra asset that's related to, it goes to reduce the overall value of your asset. And this one's related to equipment. And we're doing it for 3 months. And it tells us that our annual depreciation for equipment is $4,000. Okay? So we take our $4,000 and divide it by 4, because we're only doing it for a fourth of the year, 1 quarter. So we're reporting a depreciation expense of $1,000 and a credit to accumulated depreciation for $1,000. Yeah?
Since you have 2 different accounts for accumulated depreciation, do you do that for depreciation expense also?
Depreciation expense, you actually just load into one. No. So what I also could have done on this is I could have debited depreciation expense for $2,650 and then credited accumulated depreciation related to buildings for $1,650 and credited accumulated depreciation expense related to equipment for $1,000. Okay? There's one line item on the income statement for depreciation expense. It's all lumped together. On financial statements, it may be rolled all into one on the balance sheet, but most companies will break out accumulated depreciation for the different classes of assets. In fact, a lot of times companies will break out accumulated depreciation for individual assets because they were all purchased and sold at different times. They all have different useful lives and whatnot. Okay? And most of the time, depreciation expense is lumped into one. Question? Okay, so let's keep going. If we've got unearned rent of $4,000, okay, we've got unearned rent of $4,000 that was earned prior to August 31st. So we need to record the fact that we have earned a rent revenue, a rental revenue. We're a resort, it tells us, okay? So we earn revenue by earning a rent revenue. We have an unearned rent revenue that was earned in this period. So we need to reduce our unearned rent revenue by debiting it. For $4,000, yeah, $4,000.
Don't you debit cash and then credit on cash? It's a company that you receive the money.
You've already recorded the cash. So prior to this period, it's a great question. So somebody had walked in earlier and said, here's $4,000. I want to rent whatever, an apartment or whatever it is in this resort. So at some point earlier, you had already recorded the receipt of cash and you recorded the unearned rent revenue liability. Okay? And now what you're doing is they're telling us that, hey, you need to true up your financial statements to record the fact that that has been earned. That unearned revenue has now been earned, I think is what it's telling us. Okay? So the unearned rent revenue was actually earned. So we need to record that. So we're going to remove our liability called unearned rent revenue, zero it out. paper, extra sheets on your, in your packet. So you've got more room, just so you know. And you run out of room. The fifth thing, salaries of $600 were unpaid at August 31st. So we need to record salaries. Okay, and again, I'm assuming that at some point they recorded a salaries payable, probably. They've got salaries that were unpaid at on August 31st. So prior to making our adjusting entries, we have recorded some sort of salaries and wages expense for $600. Okay, this is not part of the answer. And we recorded a salaries and wages payable for $600. So now, what the problem is telling us is that they were that these were salaries of $600 were unpaid. No, that's what we need to record actually. Okay, so we're not paying them. I'm sorry. So, what we need to record is that the fact that they were unpaid. I'm reading it wrong. I've got summer brain too. So, we record the fact that we have yet, that our employees have earned the salary, but we haven't recorded them, we haven't paid them yet, rather. So we do need to record a salaries and wages expense for $600. Okay? And then a salaries and wages payable will be our credit, okay, for $600. They have earned their money, but we have yet to pay them. That's what that one is telling us. I apologize. I'll wake my brain up a little bit. Okay? We're all good with our debits and credits, moving our income statement amounts around, our revenues, our expenses, our assets, our liabilities, good. Okay, 6. Rentals of $1,600 were due from tenants at August 31st. Okay? So we have tenants that owe us money at August 31st. And so we need to record the fact that we have earned a revenue and we have not yet received it. Okay? And it says to use accounts receivable. So we are increasing our account called accounts receivable, which is an asset. So we increase that by a debit. Debit accounts receivable for $1,600. And we record an income, some sort of revenue. Okay, so a rent revenue is what we credit for $1,600. Revenues are increased by credits. Okay? And then the last one, the mortgage interest rate is 6% per year. And the mortgage was taken out on August the 1st. Okay? So we've got an interest rate of 6% on a mortgage. We've got an outstanding mortgage of $120,000. If you take a look on the financial statements, we've got an outstanding mortgage payable for $120,000. And we know it's 6%. We're going to pay for just 1 month or 3 months. Doesn't tell us.
1 month.
Started August 1st. Thank you very much. Taken out on August 1st. Thank you very much. Again, summer break. So we need to first figure out, we've got a $120,000 mortgage with a 6% interest rate. Multiply it by 0.06. And it was taken out on August the 1st, so it's 1 month or 1/12. Okay? So we need to record the fact that we've used this loan. We've had this loan outstanding for 1 month, so we need to record interest. When you calculate that, it's $600. So we need to record our interest expense related to our mortgage payable. We haven't paid anything back yet. We just need to record the expense. So our debit is to interest expense. We increase expenses by debiting interest expense by $600. And we credit interest payable. Good. So now we have an outstanding IOU for $120,000 for the mortgage. We have an outstanding IOU to the bank for the interest of $600. We're all good with it? Okay. Okay, so we have recorded our journal entries. Now they want us to prepare T accounts. Okay? Prepare T accounts. Do we want to do that? Let's skip that. Skip that. Let's skip that. Let's skip T accounts. Okay? Well, shit, you may have to. I think we have to. No, Yeah, we have to. We have to. Blah. Okay, T accounts, let's go. We can do this. We have to, because the next step of what we're gonna do is we're gonna prepare either an adjusted trial balance or we may just skip straight to an income statement and retain earnings statement. Okay, so T accounts, we're gonna do them very quickly. We've got our balances, just spread them out all over the page. I like to make a row of assets. So we've got a cash T account that had an initial debit balance of $24,600. Okay. And did we do anything with cash? We didn't do anything with cash, so at the end of the period, we still have a balance of $24,600. And if you do T accounts properly, you'd make your little T, you'd put your opening balance. If you had any changes, debits or credits, you'd put them on the left or right, and then you'd do a little subtotal line, get a total for it, and you can double line that sucker if you want, okay? So we've got done cash. Let's make a supplies T account. Supplies started with $4,300. And then if you remember, we used a whole bunch of supplies, so we used 3,400 of them. We made a journal entry to record the fact that we used supplies, so we credited supplies by 3,400. At the end of the period, we had $900 in supplies. Prepaid insurance. You go back and you make a T. If you look at your beginning balance from your trial balance, you've got $5,400. It's an asset, so it's got a debit balance, which means you just put it on the left side of the T. $5,400. We used 3 months worth of that insurance, so we credited it for $1,500. And so now it has a balance of $3,900. You take your $5,400 beginning debit balance, subtract off any credits you would have to get to your $3,900 debit balance at the end, okay? To keep on trucking, you've got land, which we didn't do anything with, so you start with $40,000 as a debit, you end with $40,000 as a debit, okay? I'm gonna run out of room, so I'm gonna have to make another column for my assets. You've got buildings. Okay. Buildings started off with $132,000. Didn't do anything. Okay. Oh yeah, we did. We've got buildings, but we have an accumulated depreciation related to it. So we now need a T account for accumulated depreciation related to the buildings. If you recall, when we record depreciation for long-term assets, we don't reduce the line item called buildings. We record it through accumulated depreciation. So we need to record the accumulated depreciation credit. We've depreciated buildings by $1,650 for this period. So it's got a $1,650 credit balance. Okay. Same thing with equipment. We've got equipment of $36,000 that shows on our trial balance. We didn't do anything, we didn't buy or sell any equipment, but we do have some depreciation related to equipment, so we report an accumulated depreciation. So we've got a T account for accumulated depreciation. It's a contra asset, it has a natural credit balance. We reported $1,000 of depreciation, so the end accumulated depreciation balance is $1,000. Next month, when we record more depreciation for equipment, we would just keep crediting. So our running total of accumulated depreciation, the more we depreciate an asset, keeps going up and up and up. So the net book value, when you add these two up, when you combine these two, the net book value of equipment keeps going down and down and down, right? Yep. Okay. The only other asset, we added a new asset, we added accounts receivable, so we need to include that. I'm just going to shove it up here. Accounts receivable. We now have $1,600 outstanding balance in accounts receivable. And I am sorry, it was messy. Okay. A lot of fun stuff. Makes y'all want to be general ledger accountants, doesn't it? Yeah. think all of our assets, let's go through our liabilities and stockholders' equity. We've got accounts payable. When we make a T for accounts payable, they have natural credit balances. Accounts payable starts at $6,500, and there were no changes in our problem, so it ends with $6,500 credit balance. The next line item is another liability, unearned rent revenue. I'm just abbreviating for time. Unearned rent revenue, if we look at our trial balance, it starts with a $6,800 credit balance. Okay. We earned a little bit of revenue during the period, so we recorded a debit to unearned rent revenue of $4,000. When we earned that revenue, so we've got an overall credit balance of $2,800. We still have some outstanding services that we need to provide, rent that we need to provide to our customers. Okay, $2,800. We've got a mortgage. Okay. Because we've got a mortgage payable, it starts off at $120,000 and it's got a natural credit balance. We didn't do anything related to the mortgage. We didn't pay it off or anything. So there's no change in it. $120,000. Okay. We do have some other liabilities before we get to the stockholders' equity. We have got, we reported salaries. Yep, salaries and wages payable. You remember we have a new payable of $600. We have a $600 balance in it. Yeah. And we've also got interest payable. We incurred interest that we have yet to pay, so we've got an outstanding liability for interest payable. And that was also for $600, it looks like. Our numbers are correct. Okay. You will see when you get into intermediate, you may have to do these a little bit more formally by writing the dates out and all that good stuff, but right now we're just kind of whizzing through it. Okay. And then the very last, let's get through our liabilities, our equity. Our equity, we had common stock. I'm speeding up a little bit. Common stock had a $100,000 balance. We did not do anything to common stock, so it has a $100,000 credit balance at the end. Okay. We have some other accounts. Dividends. Dividends, if you remember, have natural debit balances. We have dividends of $5,000. We didn't pay or do anything related to dividends, so it still has $5,000 at the end. What else? Rent revenue. Rent revenue is a revenue. $80,000 at the beginning. We did earn some rent revenue. We earned $4,000 rent revenue related to the unearned rent revenue that we had earned, and then we also recorded additional rent revenue of $1,600 and recorded accounts receivable for it. Okay. So we have a balance in revenue. We earned $85,600 in revenue for the period. Okay. And then we've got expenses, salaries and wages expense. It tells us that at the beginning it had a $9,400 balance. Expenses have debit balances naturally. We incurred additional expenses related to salaries of $600. So now we have $10,000 in expenses for the period. Oh, that is not right. Where am I coming up? 53,000. Sorry, I'm reading the wrong line item. 53,000. Sorry. So we have 53,600. 53,600. Okay. We have utilities expense. Okay, that was $9,400 at the beginning. We did not make any entries to it. We have maintenance and repairs expense. insurance expense. We have a $1,500 debit for insurance expense. And we recorded that 3 months of insurance that we incurred. We have supplies. We recorded a supplies expense. Because we used $3,400 worth of supplies for the period. We had a depreciation expense. Okay, our depreciation expense for the period was the $2,650. When you include both buildings and equipment. And then the very last expense, if you look at your journal entries, the additional information that we reported was our interest expense. Okay, we incurred $600 of an interest expense for the period. Having fun yet? Okay, so the last thing I want to do, I want to create an income statement and a retained earnings statement for these 3 months. Okay, and we can do that from here. We've got enough knowledge. Let's make our income statement. So we're gonna call it Death Valley Resort income statement, and it's going to say for the 3 months ended, for the period ended August 31st, 2014. The basic formula from our income statement is all of our revenues minus all of our expenses equals our net income or our net loss. Okay? Okay? Revenues. If you look at our revenue, you can take all of this information now that we've created all of these wonderful T accounts, and you can look and find where we've got revenue. We've got rent revenue of $85,600. Okay? Rent revenue. $85,600. And then we've got a whole ton of expenses. Let's just blow through them quickly. We've got salaries and wages. Look at your T account. It has an end balance of $53,600. I'm gonna make a little subtotal. So I'm putting them on this column right here. Salaries and wages. Then we've got utilities. Okay, utilities has, if you look at your T account, $9,400. Use those 2 T's. Okay, go to your other T accounts, maintenance and repairs, $3,600. Supplies is $3,400, right? $3,400. We've got depreciation of $2,650. Then our last couple, we've got insurance, $1,500, and we've got interest of $600. And I've got the cheat sheet, the answer key, and I know that if you add all of these up, you get total expenses of $74,750. Okay? And we know we take our revenues, we subtract off all of our expenses. We have a positive number, which we do. We have a net income of $10,850. Okay? That's how you make your income statement, revenues minus expenses. We quickly make a retained earnings statement. Retained earnings statement. Are y'all running out of space on the pages? No? Okay. Death Valley Resort. We make our retained earnings statement. For the period ended we remember that we start with beginning retained earnings. You add in net income. You subtract off dividends to get to end retained earnings. Okay, that's our formula for our retained earnings statement. Piece of cake. And I think we are under the assumption, since we don't have any retained earnings, that we are starting at 0. Okay? We add in our net income. We add in 10,850 that we just calculated. We subtract off our dividends, and we had dividends. So if you look at your T account for dividends, you will see that it's 5,000. And so our end retained earnings is 5,850. Okay? We have enough information to make a balance sheet. I am not going to do it. All you do is you take the balances of all your assets, all your liabilities, and all your equity accounts, you shove them into the balance sheet. Okay? We have done a very good, thorough review of the first half of this class. Let me know, Fred. Y'all know.
I think we'll get up to the third.
Okay, so what do we want to do? Do y'all need like a 5-minute break? Yes. Okay, so it is on that clock right there. It's like 27. I'm only going to give you 5 minutes. Let me tell you where we're going from here. I'll give you to 35, so we'll get a 7-minute break. Let me tell you where we're going from here. We are now going to do just like we did in the intro class. We're going to walk through the balance sheet and hit the high notes. So we're going to say, okay, you know what? For AR, these are the high notes. This is what the important topics are for inventory. Let's do a problem doing LIFO, FIFO average cost. For long-term assets, we're going to depreciate using straight line, weighted, whatever. Units of activity and all that. So that's what we're going to do. So we've got 6 or 7 problems that we're going to do related to big chunks in accounting. That's where we're going to be here for the next hour, hour and a half. Take a 6, 7, 8 minute break. Okay? Thanks, guys. This is voluntary. Just remember, you got all day today.
Yeah. Yeah, aren't you?